Hey everyone, Phil Hodgin here. Happy Friday. Welcome to the International Tax Lunch for January 2024. We do this every month, noon Pacific time on the last Friday of the month. And you can watch it live here as you are right now, or later we put it up on YouTube. This month, I'm going to be talking about CFCs and restructuring, organization, reorganization, liquidation, all that kind of fun stuff. Assuming you've got a CFC, what do you do with it now and how can you screw it up? So that's the topic for today. This is episode 9, as you can see in the 11 episode series on CFCs. Next month is going to be Section 962 elections. And then the final episode is comparing controlled foreign corporation structures for doing business abroad to other choices ranging from disregarded entities to domestic C corporation operating as a branch, blah, blah, blah. So, and we'll do some math there. Anyway, let's get going. Start the timer, Phil. So here we are. You can see the episodes. So February 23, the 962 election. March 29, the tax performance comparisons. Just so you know, for next year on the Cal CPA cycle, I'm going to be doing a 5 episode series on foreign investment in U.S. real property or 6 or whatever it is. And then the second episodes will be a long series on U.S. income taxation and estate taxation and how to deal with foreign trusts. So more fun stuff in international tax land coming up next year. So intro. What we're going to talk about in the next hour is orgs, reorgs, liquidations, blah, 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 stuff like that. And I want to give you the big picture. And the reason I want to give you the big picture is because if you understand the underlying principles, if you understand that water flows downhill, then you can work out the details for yourself. And it's not possible in an hour to tell you all of the possible, permutations and details that will apply to your specific situation. But it is possible to give you guidelines so you know water flows downhill and you don't wonder why you're standing uphill and the creek isn't coming to you. So that's the importance. Like last week, I was in Miami for the Florida International Tax Conference, 2 days of fire hose. Do I remember anything? No. What I do remember is a few in the hallway, chit chats with people. One of which was interesting. Form 8858, and is that a qualified business unit if you have an American living abroad doing a rental property? And he and I agreed that we don't know why that is a rule, and we just wonder if that's tax professionals being overly cautious. I don't know. Ping me an email if you know the answer to that. His belief is that it's not required, and furthermore, his belief and knowledge is that the IRS doesn't think about either. So that's completely out of CFC land, but it is of interest to people who do international tax practice. The big picture here is that you're going to look at the Internal Revenue Code as it is and apply it as it is. And then when you're all done, you're going to bring in 2 separate code sections that might upset the apple cart. One is Section 367, which says, hey, all of those tax-free reorgs that you think you're doing? They're taxable. And the other one is Section 1248, which says, hey, that capital gain you think you got from selling the shares? Some of it is a dividend. So that's the general process. And we're going to go through how these apply in 3 different contexts: outbound, foreign to foreign, and inbound transactions. But let's start with the simple stuff: the taxable disposition of CFC stock. So before we get into the esoteric stuff like Section 368 reorganizations, you're selling CFC stock for cash money. What happens? Well, first of all, let's look at the type of dispositions that you can have. And there are 3 of them. One is a regular sale. I give you money, you give me stock. or an exchange, functionally the same thing. I give you my 2015 Toyota Corolla, you give me stock. So that's the first one, sales or exchanges. Second one is redemptions. CFC says, hey, Phil, I'll buy your stock back from you. And I say, let's do it. Third one is liquidations, where the shareholders decide, let's to liquidate this CFC and take all the assets, distribute them out to the shareholders pro rata. So those are the three kind of transactions we'll be looking at here. And this is the normal stuff. And how does it work? Well, let's start with sale or exchange. And the basic idea to remember is when you've got a sale or exchange, it's whatever the rules are, pretend it was a domestic transaction. And then after you figured what the transaction will look like, add on section 1248. So, and in general, that's the procedure that I go when I'm trying to unravel something. I first pretend the transaction is a purely domestic transaction, figure out how it works, and then I add back one layer of complexity at a time by pretending that one party or another is a foreign party. So the idea here is section 1248 does one thing. It says, yeah, you've got a sale, but we're going to recharacterize some of the amount that you realized as a dividend rather than capital gain. That's all it does. Redemptions say you do the normal redemption, which is subchapter C transaction. And again, we're going to add on section 1248. If you've got a taxable sale, you were going to recharacterize some of the capital gain as dividend rather than capital gain. So redemptions, just to remind you how it works, this is section 302, says, look at section 302, B1 through 5. If your transaction fits into one of those 5 things, the redemption is treated as a sale of stock back to the corporation, and you treat it accordingly. If your transaction does not fit in one of those 5, then it's treated as a dividend to the shareholder, and you tax it accordingly. So the if not sale, then dividend is section 302D. And if you are in this redemption is a sale, then you say, invoke section 1248 to potentially recharacterize some of the net sale proceeds as dividends rather than capital gain. If it's a dividend, then 1248 doesn't apply, because why would you need to do a make pretend dividend when you have a real life dividend going, and you just treat it accordingly, and the dividend is reported on the shareholder's tax return. So again, see the pattern, normal Internal Revenue Code rule plus section 1248. Final one is taxable liquidation. So this is section 331, and it says that a liquidation of a corporation, again, this is when the corporation is dissolved and all of the assets are transferred up to the shareholders, that's treated as a taxable disposition, a sale, basically. There's an exception for subsidiary liquidations that I'll talk a bit later about, but it's a sale. And the gain on sale is capital gain. And again, section 1248 steps in to recharacterize some of that gain as dividend versus capital gain, on the tax return. When you have a liquidation, there are actually 2 code sections in subchapter C that come in. One is section 331 that says, hey, shareholder, you got capital gain when the corporation is liquidated. And the other one is section 336, which says to the corporation being dissolved, pretend that you sold all of your assets, recognize the gain, pay the tax, and then whatever's left over, distribute those assets after tax to the shareholder. So you can see in this case, if you have a CFC and section 336 mandates that result, pretend you sold all the corporate assets, you could have gain recognition on appreciated assets. And if you have gain recognition on appreciated assets in a CFC, or you have subpart F income, is that? If so, we'll have some income passed through to the shareholders, subpart F income, because of section 951, little a in parentheses. Or it could be global intangible low taxed income. And if that gain on deemed disposition of the corporate assets in the CFC is treated as global intangible low taxed income, then you're going to have pass through because of Section 951 Cap A, little a in parentheses. And so what will happen in the liquidation is step one, you're going to have this pass through income to the extent of earnings and profits to the U.S. shareholder, and then the distribution of the assets afterwards. So that's what's going to happen in the liquidation. So what is this Section 1248 thing of which I speak? First, the easy way to understand what's going on with tax law and to sort of make some sense of the weirdness there is to understand the sins that the Congress is trying to prevent you from doing. All right. So Section 1248, why does it exist? It exists because taxpayers like to recognize income as long-term capital gain rather than as ordinary income. And sale of stock held more than a year, long-term capital gain, tax rate 23.8%. Ordinary income taxed up to a max of 37%. Lower is better. So how does this work? Let's pretend I have a little C corporation. I'm doing consulting. So my cost of goods sold is zero. I have a client pays me $1,000. I cash the check and the corporation has $1,000 in the bank. Assume the corporation doesn't pay any income tax because it just makes the example cleaner. I wait a year and a day and I sell the shares of this stock to somebody for $1,000. Would you like to buy a bucket with $1,000 of cash in it? Yes, please. I will buy that bucket. What do I pay? I have $1,000 of capital gain, pay 23.8%, as compared to me taking a salary of $1,000 out of that C corporation or paying a dividend to myself. So that's the game, converting ordinary income into capital gain. And Congress doesn't like that, of course. And before 2017, the only rule that existed was subpart F. So if you had an ordinary operating CFC abroad, it could defer recognition of the profit that it was earning on real live businesses and to build it up, untaxed earnings and profits tax-free year after decade, which was good. And everybody loved it except Congress. And that's so 2017, Section 965, transition tax and all that fun stuff. So 1248 mattered a lot before 2017. It matters much, much less now because the 1248, what it does, it says, let's look at the untaxed earnings and profits of the CFC and treat that as a deemed dividend as part of the sale. So now in the land of subpart F rules and global intangible low taxed income rules, there's powerfully little, if any, untaxed earnings and profits in a CFC on an ongoing basis. And in theory, Section 965 would have washed out all of the historical untaxed earnings and profits in 2017. There will still be a little bit just because global intangible low taxed income calculation rules are gratuitously complex. And so it is possible for there to be a little bit of untaxed earnings and profits retained in the CFC, but so that'll get flushed out by Section 1248. But big quantities of untaxed earnings and profits, not so much possible anymore. So Section 1248 says if you are a Section 1248 shareholder, which overlaps with U.S. shareholder because you own 10% or more of a CFC stock, and you have a disposition of that stock for a capital gain, then you're going to have a deemed dividend equal to the pro rata share of earnings and profits for the stock that you sold. You own 100%, you get 100% of the untaxed earnings and profits passed through to you. You own 25%, you get 25%. And that's what it does. The dividend will either come out as an ordinary dividend or a qualified dividend, depending on whether there's a treaty that allows you to treat the dividend as a qualified dividend. Obviously, If you have an individual shareholder and it comes out as a qualified dividend, taxed at the same rate as capital gains, who cares, right? So for an ordinary individual shareholder, Section 1248 can only either keep things at par, so all the gain on sale is taxed at 23.8%, or it can make it worse. Some of it, the capital gain portion, will be taxed at 23.8%, and the dividend portion will be taxed at ordinary rates. But that, in a nutshell, is how it works. And of course, there's just endless Baroque exceptions and rules and curlicues and whatnot, but that's the idea. So, with that in background, on 1248 lurking in the background of the transactions and how it will apply, it'll come into play in the future in the rest of the presentation that I'm going to give here, where we're talking about reorgs, liquidations, and the like. And in some types of transactions, 1248 will be invoked, and in some it will not be. But for organization, reorganization, liquidations, the big one that we're going to be looking at will be Section 367. So, three types of transactions that can be tax-free. We talk about outbound transfers. So, classic example is U.S. person makes a capital contribution to a foreign corporation. There's an outbound transfer of an asset to a foreign corporation. How is it treated? The second one is foreign to foreign transactions, transfers from one CFC to another. Let's say you have a parent company CFC as a couple of subsidiaries. Merge the subsidiaries together. Assets go from one CFC to another. What's the impact on the U.S. shareholder at the top of that little Christmas tree? Third one is foreign to U.S. transactions, inbound asset transfers. So liquidate a CFC into a domestic parent corporation, for example. What happens? So let's look first at outbound transfers, because this is a relatively clean, conceptually, thing that gives you the introduction to how Section 367 comes in kind of as, the ace of trumps in this game, says, nah, not going to happen. It's taxable. So outbound transfers. Starting at the beginning, like, again, basic principles. Now, and people, I get the question more than once, how do I get good at international tax? Well, the answer is you just work at it, and it takes time, but it'll come, and you work at it systematically. And here you can see I'm starting my analysis at Section 1001, which is there a sale or exchange? So when I was learning this, so I'll give you two ways to learn this. One I've heard from a friend. When I did this, for the longest time, I would start with Section 61 for every question I asked. Is this gross income? Then you go to Section 62. Is it, is anything taken away to become adjusted gross income? Section 63, what deductions are allowed to go for to taxable income? And I went through that drill again and again and again until it became second nature. And the principle there to remember is, until proven otherwise, everything is taxable income. And the other principle is, until proven otherwise, nothing is deductible. And when you operate under those things, then you kind of know how to navigate your way past. Well, Section 1001 sort of is a precursor to Section 61, because income only happens when something happens. I mean, unless you have a magic mark to market, let's pretend transaction, but let's ignore that. So Section 1001 says if there's a sale or exchange, then you have gain recognition, and then you go to Section 61 and say, is that includable in gross income? Yeah. And then you go through and you figure out how it's taxed. Once you figured that you're going to have it recognized, then you find a non-recognition rule that takes it out and stuff like that. So section 1001, and I commend this to you, always use, start with section 1001. So you have an exchange, some kind of exchange. And then in the outbound one I'm going to show you is it's going to be a classic section 351 transaction capitalizing a corporation. So on the one hand, I'm saying I'm going to transfer this asset to a CFC, me, and I'm going to get shares. Well, that's an exchange. I lost ownership of an asset and I gained ownership of a new asset, shares of stock of the CFC. On the corporation side, they have an exchange too. The corporation does. And the exchange is I got this asset from Phil. I gave Phil the stock. And so these are both exchanges under Section 1001. And so until proven otherwise, you have to assume both ends of that are going to have taxable recognized gain, right? So that's how it works. Now we go on to the next stage, which is I don't like that result. Is there some special rule that makes what is taxable and recognized gain into non-taxable, non-recognized gain? And the answer is yes, Section 351, which we all know and love. But so, and again, let's start. If you start at the very beginning, you understand where Section 351 comes into the equation. And if you just start when I'm going to form a corporation as tax-free, and you don't understand the why because before it, you will be led astray, particularly in this area when you see how Section 361 comes into the game. 367, pardon me. So Section 351, just in the domestic context, says I give corporation property, money or property. I get stock in return. There are a bunch of other requirements. And if that happens, it's a non-recognition event for the shareholder, me, and it's a non-recognition event for the corporation. Because if I transfer a piece of real estate to a C corporation that's worth $100,000 and they pay for that piece of real estate with shares of stock in which the corporation has a zero basis, then the starting line for that corporation, the C corporation, is $100,000 of gain just to get organized. So that's the classic Section 351 thing that we've looked at forever and ever, all of us. The trump card comes, Section 367A1. 367A1 is the outbound transfers where they say, if you have the right kind or wrong kind, let's carry on the slides. If you have a right kind or the wrong kind, depending on how you look at it, kind of transaction, then the non-recognition rule that you're relying on, in fact, gets blown to smithereens and you can't use it. So let's first look again, stepping back, principles before details. Why does Section 367A1 even exist? Why are they taking non-recognition rules that work perfectly fine in the domestic context and saying, nah, you can't use that in the context of outbound transfers from a domestic taxpayer to a CFC or to a foreign corporation generally? So there are two competing tax principles here, one of which is sort of a general policy decision that Congress made way back in the day. Makes sense, and said, look, taxpayers should be able to organize and reorganize their business operations without any tax toll charge, unless, of course, they're cashing out and they're converting stock into money or something like that, in which case they pay. But as long as there's no cashing out, generally speaking, it's going to be a non-recognition event, and as long as you do the paperwork, all is well. So that's the first thing. Make it easy for taxpayers to be efficient. The second one is foreign corporations are only taxable on US source income. And the policy behind that is America, despite its desire, does not have enough guns and soldiers to force every corporation and every individual outside the borders of the United States to pay tax in the United States. So this is a recognition of reality that we can't tax everybody. So we're only going to tax stuff that occurred inside the United States. Well, what happens if you have an appreciated asset, for instance, and you transfer that appreciated asset from a US taxpayer who sooner or later will sell, and sooner or later there will be gain recognition on that asset, and you transfer it tax-free to a foreign corporation where that asset is now sold and it's not US source income, and that gain will never be taxed by the United States. Not so much fun as far as the Congress is concerned. And so this is how the Section 367A1 does this. It says if you do one of these non-recognition transactions, so you can see them listed here, 332, so that's a liquidation of subsidiary into a parent, 351, which, capital contribution to a corporation, 354, 356, that's the tax consequences to a shareholder if there's a Section 368 reorg, and Section 361, that's the tax consequences to a corporation if there's a Section 368 reorg. So if you have any one of these things, then, and you have a US person transferring property to a foreign corporation, then we're going to pretend that the transferee is not a corporation, it's just a nothing. And every one of these code sections that are listed there assume that the transferee is a corporation. So if the transferee is not a corporation, then the code section simply doesn't apply. So think about it as Section 351. I'm setting up a CFC. I'm going to be the sole shareholder. I'm going to put some appreciated asset into it. I'm going to rely on Section 351 to make this a non-recognition transfer from me, the US person, to the CFC. Well, if you look at Section 351, it talks about a transfer from someone, US, anybody, any kind of taxpayer, to a corporation. Well, if it's not to a corporation, then it's to what? I mean, it doesn't apply to transfers to a disregarded entity, doesn't apply to transfers to a partnership, doesn't apply to transfers to a trust. And so by the simple expedient of the code's favorite game, which is let's pretend, we're going to pretend for this purpose only that the CFC is not a corporation. And as soon as you pretend that the CFC is not a corporation, then all of the non-recognition rules listed here fall to the ground, making the transaction automatically taxable. So I'm going to walk you through here how I go about thinking about an outbound transfer, and or indeed any kind of going through a process like this. Meaning, how do I figure out the answer to a tax question? So the first thing I do is first, I pretend that the whole transaction is completely domestic. So in this case, we've got a US person, we've got a CFC, we've got a foreign corporation. It's not yet a CFC because it hasn't issued any stock, right? So you can't say that it has more than 50% owned by US persons. Next, we're going to identify the outbound transfer. So tax doesn't happen in a vacuum. Tax happens when there's a transaction of some kind or another. So you're going to identify the transaction. Did I contribute cash to this CFC? Did I contribute appreciated asset? Did I contribute what kind of appreciated asset? Intellectual property, stuff like that. Intangible personal property. So once you know that what the transfer is, then you go to the basics of tax law, right? Section 1001. Is this a sale or exchange? Well, yes, it is, because at the end of this transaction, I'm going to release ownership of cash or property, and I'm going to own stock. But if for some reason, when the transaction that you are looking at, you say, no, in fact, this is not a sale or exchange as classically defined in Section 1001, then you're done. You don't have a taxable event. But if you do have a taxable event, then we're going to go on to the next step, which is we're going to be on the hunt for something to shield us from the tax consequences of this transaction, namely a non-recognition rule. So next, we're going to hunt around for a non-recognition provision that will prevent gain recognition. And if you say, now I can't find anything, then you know that it's still a taxable transaction, and Section 1001 is going to treat it as a gain recognition event. And it doesn't matter whether you go look at Section 367A1 or not, because it's taxable already. So you don't, taxable twice. It's like the old joke about the drunk goes into the bar and there's a sign in the window and the bar says, all you can drink for $20. And the guy puts down $40 on the bar and says, give me two of those. You're taxable, you're taxable. It doesn't matter if two code sections say you're taxable. But let's assume that we found a non-recognition provision, 351, and we go to the next step. Now, what I do is say, okay, I know that I've got everything within the code except for the special weird stuff that applies to foreign transactions. I've got it nailed. I understand what it is. Let's reverse it. And now we're going back to knowing this really truly is a foreign corporation. Now I've identified the foreign code sections that apply to maybe upset the apple cart here. So section 367A1. And if my non-recognition provision is not listed there, the same way with the code works, if it's not specifically called out as taxable, then the code section doesn't apply. So, you'll look at that. But if your non-recognition rule is one of those listed in section 367A1, then we've got gain recognition because the non-recognition provision doesn't apply. But even though we're at that and we say, okay, 367A1 tells me I'm going to have gain recognition on this outbound transfer of assets, we're not done yet because there are some exceptions and modifications in 367A1. And you're going to look to those and say, is there anything that makes it a little bit less bad or at least different? And once you've gone through the modifications, then you're done with your understanding whether you've got a taxable or non-taxable event. All of this, if all you come out of this hour with is treat this as a normal domestic transaction, then open up the book and read section 367 and see what happens. That's good enough because you've put yourself in the game at that point. You've put yourself in the place where tax might occur behind your back. So let's apply this to CFC formation and capital contribution because it's very simple. So we're forming a new corporation. Here's the normal transaction that we expect to see in 351, non-recognition on both sides of the equation. Capital contribution, section 367A1. Does 367A1 override what we expect to see? Hell yes, it does. 351 is one of the specific non-recognition rules that's called out. And you see there in the bold. So if you've got a 351 transaction, the foreign corporation is not considered to be a corporation. Doesn't matter what else it is, it's just not a corporation. And if it's not a corporation, 351 is not operative. If 351 is not operative, you fall back to section 1001, which is the gain on sale or exchange of an asset, and you've got taxable event. So there's this, you can see 351A says transfer to a corporation. And we don't have a corporation because section 367A1 says it's not a corporation. And the final result is, until proven otherwise, a section 351 transaction is going to be a taxable exchange. 351 applies, but it doesn't apply. And therefore, we fall back and we have gain recognition. And that's what we're going to expect. And indeed, in the big picture, as you're operating and giving advice or looking at something and trying to figure out how did this thing get taxed, just assume until proven otherwise that outbound transfers are going to be taxable. But let's look at the exceptions and modifications. Outbound transfers of intangible property. Okay, so 367A1 applies to all property. Section 367D says Yeah. But if you have a transfer of intangible property to a foreign corporation, don't use 367A1 to determine the tax result. Instead, use 367D. And what 367D is said, well, actually, it's a gain recognition event, all right, but instead of a lump sum at the moment of the transfer, it's going to be a deemed payment over the lifetime of that intangible property. So if you are transferring a patent with 10 years to run, then there's going to be some deemed payments over the next 10 years, computed as a function of usage. And you're going to have income for each of the 10 years. There's a maximum cap of 20 years maximum. So if you have an asset that doesn't have a defined life, you know, trademark, right, and run on forever, then it'll be a 20-year payout. So same result, taxable, but just different payments structure. Instead of a lump sum, spread it out. Then let's talk about exceptions modifications, where it is possible that this outbound transfer might indeed qualify for Section 351A non-recognition after all. So here's the reg that you need to look at. It says, there are three regs here, -2, -3, -4, that say, no, we'll actually pretend that the foreign corporation is an actual corporation, and therefore you can use 351 to make it a non-recognition event for the outbound transfer. So -2 is gone because of the Tax Cuts and Jobs Act. The underlying code section that -2 was written about is gone. They haven't updated the regulations yet. -3 is transfer of stock or securities to a foreign corporation, and that's tied to Section 367A2. So we're still within Section 367A, which is the outbound transfers, but it's a different code section. And then the -7 regulations, outbound reorganizations based on 367A4. So 367A, generally, all the outbound stuff. 367B, generally, foreign to foreign and inbound stuff. Just so you know, we will come to the inbound and foreign to foreign in a sec. So high-speed details here. Outbound transfer of stock or securities. So not all property, but stock or securities. So you've got a U.S. person transfers stock or securities of a foreign corporation. 367A2 says non-recognition if at the end of the day the transferor owns less than 5% of the transferee, or you end up with owning more, but you do a gain recognition agreement with the IRS. And generally, a gain recognition agreement with the IRS says if nothing bad happens in the next 5 years, then you've got non-recognition. If otherwise, you've got gain recognition. So that's what that means. Outbound reorganization. I will come to a slide a couple from now where you will see learned professionals saying bad things about the -7 regulations and this specific rule. But the gut of the idea is you've got a reorg and you're looking at the transferor corporation and the ownership of the transferor corporation, and is it closely held by 5 or few domestic corporations. So my practice, my life, I don't have this because I don't deal with giant juggernaut multinational corporations that have esoteric structures like this. But this is what you're looking at. And even if all you do as you're going through there, you look at Section 367A4 and then you look at the regulations, say, nope, that don't apply to me. That's all you have to do. But at least look at it and check the box saying you looked at it. And the effect of this is you can get non-recognition treatment for transfers, outbound transfer of foreign corporation stock to a foreign corporation. So, I mean, for example, I own CFC1 stock and I transfer CFC1 stock to CFC2. There's an example. So you can get non-recognition treatment there. The non-recognition for this other one, these 367A4 rules, is only if you look at the transferor and you have a very special kind of case where you have 5 or few domestic corporations owning the transferor corporation. And this is all I want to say about 367A4. See, 2 quotes. Byzantine, even by tax law standards, and an IRS person who was working on the regs calling this an international M&A PhD course. I try in my life to understand the Pareto principle very well, and particularly in what I do and what I tell you. So what is going to cover 80% of your life as a tax practitioner? And I'm telling you, unless you're in a weird backwater of Deloitte or a place like that, I think you're going to be unlikely to touch these kind of things right here. Therefore, we cheerfully ignore them. Right. So that's outbound. Remember, general rule, you see stuff moving from owned by a foreign person to owned by owned by a domestic person to owned by a foreign corporation. Assume 367A makes it a taxable event until proven otherwise. Let's go to foreign transactions. So again, let's look at the sin. What is the government looking for here when you have a foreign transaction? Merger of 2 CFCs. Why does it even matter? Well, what matters to the government is not so much what happens as a matter of corporate law outside the United States or financial statements under whatever country's normal accounting principles, or indeed tax results under a foreign jurisdiction. What matters to the US government is the impact on the US shareholder. And in the US shareholders context, when you're a shareholder, we go back to section 1248. Earnings and profits, if they are of the right or wrong kind, depending on whether you look at how you like to look at it, those earnings and profits are passed through to the US shareholder and included in the US shareholder's gross income, either Subpart F income or global intangible low tax income. So anything that you do in reorganizing, restructuring CFCs outside the United States, if by doing that restructuring, you interrupt the ability of the US government to tax those earnings and profits, then government not happy. And that's where section 1248 comes in. So the types of foreign transactions that we're going to talk about are tax-free reorgs. So section 368, right? And there's A through G or whatever it is. And the reorgs, if you have one of those transactions, then the tax-free aspect of it is covered by 354 for the shareholder and 361 for the corporation. Tax-free capital contributions. What if CFC parent decides to spin up a sub, which is also a CFC, and make a capital contribution? What happens then? Tax-free subsidiary liquidations. What if you have parent subsidiary CFCs and CFC parent decides to liquidate CFC subsidiary into it and just have a single company left over? These are the ideas that we're looking at. The default water runs downhill idea here for foreign to foreign transactions is it's going to be non-recognition gain situation until proven otherwise. So as compared to outbound, where you assume it's going to be a recognition event until proven otherwise, here is going to be a non-recognition event until proven otherwise. How does that work? In the situation of the outbound transfers, remember that 367A said, nah, if you have one of those non-recognition transactions, the recipient corporation is not a corporation for purpose of interpreting section 351, for instance. Whereas here, 367B says, if you have one of those same kind of transactions, and it's going to be considered a corporation. So it's like the upside down part of it, except to the extent, you don't, they, traditional. We're going to stop you if you try to abuse it. So foreign to foreign transactions are going to be non-recognition event by default. And you see that if you look later at the section 367A1 and 367B1, note the critical difference. 367A1 says in the case of a transfer by a U.S. person to a foreign corporation. 367B1 says if there's no transfer of property described in A1, right? In other words, there's no transfer by a foreign person, then we assume the thing is still a corporation. And so if take my example of liquidation of a subsidiary into a parent, transferor is a foreign person, foreign corporation, transferee is foreign person, the parent company. So how does water runs downhill? It's a non-recognition event. How does that get trumped by, because there's always an exception to the rule? Well, they gave us 3 specific exceptions and from the regs. So let's look at each of those 3 in sequence. And the first one is, as I mentioned before, this section 1248. So the important feature of the Internal Revenue Code, subpart F generally, is the ability of the Internal Revenue Code to push earnings and profits from a CFC upstream until it hits the gross income of a U.S. shareholder. Because section 1248 status and U.S. shareholder status basically look the same, if you have an interruption of that status, someone owned 10% or more before the reorg, and after the reorg, they don't own 10% or more. Well, you own 10% before, you own 5% after the reorg. You're no longer a U.S. shareholder. It doesn't matter whether the thing is a CFC or not. Earnings and profits are not going to be pushed upstream to you and reported as part of your gross income. So the government has lost the ability to tax the earnings and profits. And if there's any latent untaxed earnings and profits still lurking inside the CFC, that's gone forever out of the US tax system. So this by far is the most important one that we watch every time. And that, I'm going to be doing a workshop on this later. Send me an email if you want to be on the list. I'm going to be talking to the accountant next week, and we're going to start working on the compliance for it. But I did a 368 transaction like this last year, and you can see all the compliance where we will show that before and after the reorg, the section 1248 shareholder status remains in place. So details in that's going to probably come towards the end of February, but email me. So section 1248 is going to be the one that's going to matter to you most. In fact, this one, again, just because of the kind of practice that I have, which is people who got money or make money, and not so much the big megacorps, an E&P shifting transaction. What is this? Well, go back to this idea the U.S. shareholder gets passed upstream in some fashion or another, untaxed earnings and profits, and they're taxed as part of the gross income, either subpart F income or global intangible low tax income. Along with that, if you have a domestic C corporation as the shareholder, there's the ability to take the indirect foreign tax credit. So take a indirect foreign tax credit to the extent of corporate income tax paid by the CFC to a foreign country. And the amount of indirect foreign tax credit that you can take is a function of how much income inclusion you have. And so people will play fun and games with the capital structure of a corporation to try and shove E&P artificially in one direction or another. And this specific exception is no can do. So the big tell in this poker game is if you see a reorg and all of a sudden somebody ends up with a bunch of preferred stock, just watch out for that, because that's the game. And in fact, one of the requirements of this thing in E&P shifting transaction is the presence or absence of preferred stock. So again, I don't see these, but just know they exist and be aware if something happens. And then the third one is a Section 368 recapitalization. So this is a single entity reorg, right? It's just you start with a single class of shares, ordinary shares, for instance, and you recapitalize the company so that you have some preferred stock and you have some ordinary common stock. And ordinarily, this is a tax-free transaction. Well, going back to the earnings and profits shifting fun and games, can we do in two steps what we can't do in one? And we spread it out over time. And this specific exception is designed to stop people who are trying to be clever that way. So they look backwards 2 years and they look forward 2 years from a 368 A1E recapitalization and say, did something bad happen to do earnings and profits shifting 2 years before or 2 years after? If so, gain recognition. The effect of losing gain the non-recognition treatment is, again, the Section 1248, we're going to shove the untaxed earnings and profits upstream to the shareholder. Finally, let's wrap up with foreign to US transactions. So this is inbound stuff. So you're looking for a liquidation of under Section 332. Section 332, just for your memory, in the purely domestic situation is you have an 80% or more owned subsidiary liquidating into the parent. And the general rule is no gain recognition and the transferee parent company succeeds to the tax attributes of the subsidiary, this being liquidated. Section 368, you have some asset, transactions, asset reorganizations, and so you have a 368 asset reorg that ends up with the domestic parent owning the foreign assets. So in both cases, we've got assets coming inbound. And here, again, the same old sin. We had some untaxed earnings and profits. Didn't pay tax at the corporate level to the United States on the CFCs corporate earnings, and it was not shoved through to the shareholders' gross income by subpart F income or global intangible low taxed income. So in one of these transactions, what you're going to have is a deemed dividend of the untaxed earnings and profits allocable to the US shareholder. And that's going to be the tax consequence of that transaction. All right, conclusion. Let's wrap it all up and summarize. So disposition, do your normal domestic tax computations and analysis, add Section 1248 on top. If you have untaxed earnings and profits in the CFC, expect that to be a dividend. For US to foreign corporate transactions, you do the normal domestic analysis, you add Section 367A to your analysis. And the general expectation is you're going to have recognition of gain. For foreign to foreign, you do the normal kind of 368 stuff. And true confessions, if you feel brain damaged when you're trying to understand 368 reorgs, welcome to the club. I have to draw little pretty pictures to myself and go really slow before I understand what's happening. So I feel your pain. But for those, you're going to add Section 367B to the analysis after you're done. Finally, for the foreign to US, so the inbound transfers of assets, again, you're going to be looking at the normal rules plus Section 367B, where you're going to flush untaxed earnings and profits upstream and get it taxed in the United States. And that's the general idea. And this particular one has been particularly light on details just because there are so many. And we could get into the weeds about talking about Section 368 and what is an F reorg and what is this and what is that. And it's beside the point. But It's enough for you to know where the danger lurks and avoid those.